Picture this scene. A refrigerated container packed with American beef arrives at the port of Shanghai, but it's not allowed to unload and is sent back instead. At a supermarket in Iowa, a sign reading "Out of stock on shoulder steaks" hangs limp, even though beef prices are still over $6 per pound. And in Tokyo, upscale barbecue restaurants once loyal to American beef have just signed new contracts to import meat from Canada. These aren't isolated random events. They are the cascading consequences of a misguided policy, tariffs imposed at the wrong time and on the wrong targets. And perhaps the most heartbreaking part is that the consequences are being felt by everyday Americans, from urban centers to rural communities. Things started to heat up in March 2025. The Chinese government allowed over 1,000 U.S. beef export licenses to expire. A quiet yet highly effective move directly affecting over $5 billion worth of signed contracts. According to a report from Reuters, in the final week of March alone, the amount of U.S. beef purchased by China dropped dramatically, from over 2,000 tons per week to just 54 tons. That's a staggering 97% decrease. This marks the largest drop in the history of agricultural trade between these two economic powerhouses. The official reason was never publicly disclosed. However, analysts believe this was an indirect but masterfully strategic response to the new tariffs imposed by the U.S. government in February and March of that year. China didn't need to make loud announcements, hold press conferences, or issue overt sanctions. They simply let the licenses expire. A silent move, but with a powerful punch. When beef can't be exported, there's a local surplus in supply. Sounds good, right? But it's not. This quickly leads to fewer cattle being slaughtered, which then creates a shortage of steady supply, pushing beef prices to unprecedented highs. Ground beef prices shot up to $6.12 per pound in June 2025, a 14% increase compared to the same time last year. Prices for boneless steaks soared even higher, reaching $11.49 per pound, the highest since 2015. At schools, many lunch programs have had to cut beef from their menus due to budget constraints. No one is directly taxing the beef you buy at the supermarket. But the result is, American consumers are paying a sort of hidden tax right on their dinner plates. The consequences don't stop at beef prices. Businesses at the start of the supply chain, those that process the meat, run slaughterhouses, and handle logistics, are facing massive inventory backlogs and a drastic drop in orders. Tyson Foods, a major player in the meat processing industry, reported a loss of $181 million in its beef division alone in the first 2 quarters of 2025. Factories in Kansas, Iowa, and Nebraska have had to reduce shifts, and some areas have even reported halting slaughtering operations entirely through the summer. Take the Emporia, Kansas plant, for example. It used to operate 3 shifts a day, but now only runs in the mornings. Meanwhile, tens of thousands of pounds of meat remain in cold storage, waiting for a market that doesn't know when it will open again. An unexpected shock: the decline in meat exports triggered a grain surplus crisis. In 2024, 100.7 million bushels of soybeans were used to produce exported meat, bringing in $1.12 billion in income for farmers. But when the meat couldn't be exported, surplus soybeans and corn flooded the market, driving prices down. This pushed many farms into financial difficulty. This is a clear illustration of the tight interconnections in the agricultural supply chain. While the U.S. is still struggling with suspended export licenses, Canada has swiftly filled the gap. In March 2023, Japan lifted its 20-year ban on importing processed beef from Canada, a golden opportunity. By May 2025, Canada's beef exports to Japan had increased by 13.1%, primarily in frozen pork and beef. But Canada didn't stop there. Ottawa poured over $1 billion Canadian dollars into expanding cold storage facilities and building a provincial cold rail system. More importantly, Canada signed free trade agreements with several Southeast Asian countries and is currently in negotiations with the Mercosur bloc, including Brazil, Argentina, and others. While the U.S. is still negotiating with China to get its licenses back, Canada is already on the dining tables from Tokyo to Seoul, seizing every opportunity. As predicted, China didn't make a big fuss, no press conferences or public sanctions. Instead, they simply let the U.S. beef export licenses expire and added a modest import tax, 10 to 15%, enough to cause serious damage. In June 2025, China renewed licenses for 106 U.S. pork and poultry plants. However, they made no mention of beef. This is how Beijing pressed the pause button on U.S. beef, a move that didn't make headlines, but its strategic effectiveness and impact were incredibly high. In the increasingly complex trade landscape, the U.S. still has a chance to return, but this requires a strategic, decisive move with long-term vision. The U.S. can no longer just play the role of the largest seller and expect customers to remain loyal forever. Countries like Japan, South Korea, and China are increasingly prioritizing the reliability of their supply chains over price. And it's clear that the disruptions caused by lost licenses and tariffs have severely damaged America's reputation in the eyes of importers. Canada has shown that investing in cold infrastructure is the new weapon in the meat trade. Canada may not have a larger cattle herd than the U.S. or a more favorable climate, but they have a clear strategy. Support cold transportation directly to Asia, invest in long-term storage capacity, set quarantine standards that meet the needs of the Japanese and Korean markets. So why doesn't the U.S. follow suit? Why not learn from the successful strategies of competitors? Rebuilding cattle herds isn't just an agricultural issue, it's an urgent financial problem. With reinvestment costs reaching thousands of dollars per breeding cow and a recovery period of 2 to 3 years, farmers need clear capital and risk insurance. If the government doesn't intervene strongly, the scarcity cycle, high prices, will continue into 2026 to 2027. According to a USDA report from June 2025, the cattle rebuilding rate in the Midwest is only 38% of the target, largely due to a lack of financing and uncertainty about output. The story of meat is not just about food. It reflects the current mindset of U.S. economic policy, believing in a leadership position to the point of arrogance, using tariffs as a pressure tool without considering the ripple effects. Slow to invest in logistics systems while competitors are speeding ahead like bullet trains. And perhaps most tragically, the people, those at the end of the supply chain, are the ones paying the highest price. Whether it's family meals, school lunches, or farmers' seasonal loans, everyone is paying the price for a trade policy that has failed to control its consequences. In the global trade chess game, those without a clear strategy will end up in checkmate. Canada has shown that it's not about being bigger, but about calculating more accurately, moving faster, and thinking smarter. The U.S. still has pieces on the board, but if it doesn't make the right move at the right time, it won't matter if there are no extra tariffs from China or bans from Japan. Its internal system will inevitably box itself in. What do you think about how the U.S. is handling the meat crisis and the current export market? Does Washington have the foresight to hit the brakes, make adjustments, and reclaim market share? Or are we witnessing the dawn of a maple era in the global food industry?